I want to get on and talk about something really important. It was sparked from a client meeting that I had just a few days ago, and I want to go over the lessons that I learned, hopefully that the client learned. One is a lesson in perspective, and one is a lesson in empathy. Maybe they're more related than you think, but uh, what I took away from that meeting and how it will maybe shape my communications with you, the audience, and with my clients. Also, what hopefully I'm doing a better job of as an advisor, which is setting proper expectations, delivering perspective, even when I personally am not uncomfortable. I need to do a better job of recognizing that that might not be the same for my clients. So we're going to go over what we discussed in that meeting, and I think you're going to take a lot away from it.
You're listening to Advise with Rick Lucchini.
This isn't super new. It's a panicked email from a client. Market's going down. TV's telling them the sky's falling. Not a huge fan of the current administration. This is not a political episode, but that's just what their concerns are. So they're constantly being reaffirmed what they already believe, which is bad things are happening. Bad things are happening because they're being told that by the TV. They're being told that by their social feed. And it's repetitive process that's reaffirming what they already believe, which is things are bad. They're going to get worse. They log into their accounts, see negative signs, accounts are going down. See, I told you, go back to the TV, see, there it is again. Everything's bad, right? Does that sound like you? Keep listening. Now, here I am, their advisor that they pay, that have built a sound financial plan and what I believe is a sound portfolio that has these times built in. We have a buffer built in for these times. We already know these things are going to happen. So we've built the strategy around knowing that these things are going to happen without having to make knee-jerk reactions. So I'm calm. I'm going about my business. Getting ready for tax planning on my spring meetings and readjusting portfolios slightly, recording podcasts. Just opened my first Instagram account. If you want to follow me, it's at Rick Lucchini _. And I'm just going about my business. I'm happy. Not a whole lot of clients are emailing me and calling me with concern because they have, I think, reasonable expectations. And then I get this email from a client saying, I'm stressed. I'm looking at this and I really need to talk about what to do. That really just kind of honestly hit me because I'm not thinking that way. Right. And it really is my job to not just project how I feel, but to understand better how you, the client, feels, what you're going through. You don't know what I know, and you're not as confident maybe as I am. And maybe that's because I'm not communicating enough with you. So they were almost apologetic. Like, I don't want to, be a bother or whatever, but no. This actually is my fault as the advisor. It's not communicating enough, not reaching out saying, hey, listen, I know the market's doing this. Here's how it affects you. I know the news is saying this. Here's how it does or does not affect you. So that one was on me. And when we started talking, I understood more why they're concerned. They're not concerned that their portfolio is down $85,000. They're concerned that they don't understand when and if that ends, right? I can extrapolate that I lost $85,000, and this is off of, just for perspective, a little over $1.3, $1.4 million. I lost $85,000 in whatever that time frame was. It was short, a month, let's say, okay? That's really not the concern. The concern is when I extrapolate $85,000 by a month, right? I go out 2 months, 3 months, 5 months. I'm out of money in 11 months, 12 months, 13 months. Money's gone. Everything I worked for, all my savings, all of my security is gone. That's what they think. I don't think that. I don't believe that. I actually know better than that. And so I don't have the same concern, and I'm not being proactive enough to get out in front of that. When I explained how they're invested, why they're invested, what's actually happening with the economy, why the market's doing what it's doing, what the key indicators are for future growth that we're actually seeing right now, mindset shifted a little bit. Here's where it's really key. What is the alternative? Okay. Now, if you hold shit, then you need to be worried all the time, because things can go down and they can stay down forever. They can go to zero. All that being said, we're working under the impression that you have a well-built portfolio, and the things that you hold, you should continue to be holding. If that is the case, short-term volatility should not change how you're invested, and it should not change your financial plan dramatically. What is the alternative? The alternative is not invest for growth when things get bad, invest for safety. When that bad thing is over, invest for growth again. That's called timing the market. It does not work. There are people significantly smarter than me that have much more resources that have been trying to do this for years. It does not work. Building a portfolio and then slightly adjusting it over time with the intention of long-term growth is what works. There's math behind that, and history is on our side. But what that means is short periods of being uncomfortable for long periods of growth. So what's the alternative? The alternative is not timing the market. The alternative would be a safe asset, something that is like let's say a CD, for example. Here's where the perspective comes in. I looked at the numbers 2 years ago. They have about $1 million. If they put that into a CD and assume no risk, okay, let's say they get 4%. Now, again, the last 15 years, that number is going to be a lot smaller. And I think in the next 15 years, that number is going to be a lot smaller. In today's environment, let's say they can get 4% on that money. 4% over the last 2 years gets them to about $1,080,000. No negative signs, no market risk, no nothing scary. Okay. That's the alternative. That is the safe alternative. Doing it our way, they give back $85,000 of gains, which is their perceived loss. The market's going down. I'm losing money, right? Account value during this conversation, let's call it about $1,265,000. Okay. So being uncomfortable, giving away gains, watching the account go down, they're to the good versus the safe alternative by $185,000 in 2 years. And we know market's up yesterday, market's up today. We know we're going to get that back, and it's still going to be to the good 200,000, 2.25, 250 over the next year or so, right? Easy for me to say, hard for you, the investor, or you, the client, to appreciate, because when you see it going down, you don't see the end. But let's take a step back and look at the alternative. The alternative is not absolute perfect timing of the market. It just does not happen. And so if the alternative is, I give you 2 years ago the option, you can have absolutely no fear for 2 years. And in 2 years, you have $1,080,000, or 2 to 3 months of being uncomfortable across 24 months. And in 2 years, you have $1,265,000. Every person that I talk to is going to take the latter. They're going to take that deal. Our job, my job, is to do a better job of setting that expectation up front, so that during that time of fear, you can recall the deal that you made with yourself, or the deal that you made with your advisor. We understand this is already baked in. This is set to happen. The portfolio expects this to happen. And that's why we have these other assets in there. Because if we weren't expecting this to happen, when times are good, we'd actually make even more money because we'd have even more risk on assets. We have the buffer built in for this to happen. We have it for your income as well. That's why we use dynamic guardrail income. We know that if things get bad enough, we have a mechanism built in to adjust your income for a short period of time so that we don't blow the whole thing up because of something we can't control, which is the stock market. We can control the things around it, how we're allocated, how we're withdrawing money, how much taxes we pay. And then that brings us into an opportunity. The conversation then switches to, okay, if we're all on the same page here again, no one's rooting for the market to go down, right? I'm not. But when it does, and we know it's going to, do we just, unplug the phone and hide under the desk, or do we look for opportunity? That opportunity is Roth conversions. If we have a Roth conversion strategy already built out and ready to execute, when the market goes down, we're actually converting more dollars tax-free, paying less tax on that. Well, your dollar goes down to 75 cents. So when I transfer that 75 cents over, I'm only paying tax on 75 cents now instead of the dollar. When the market comes back 2 months, 1 month, a week, 3 months, I don't care when it is, that 75 cents goes back up to $1. That 25 cents is now 100% tax-free. Moments later, months later, you just got a 25% bump on that tax-free. And now set to grow normally for the next 5, 10, 15, 20 years, whatever it is. There's some opportunity there. If you're younger, I'm not doing Roth conversions, dude. I'm 40 years old, working. Awesome. Every time the market goes down, you continue to put in your 401k, you make your Roth contributions, you're doing backdoor Roths because you're high income, whatever the strategy is, you're buying those shares at a cheaper price. You're getting more for your money. You're buying it on sale. It's an opportunity. Okay. Another opportunity that you're probably not going to execute by yourself, but your advisor can, is tax loss harvesting. You've got non-IRA accounts, regular brokerage accounts. Positions go down, positions that maybe you want to get out of, or you just have a big tax gain and you have some withdrawals coming up. Now I can sell something at a loss, harvest that loss, then buy the new thing so that when I get a gain there, it can offset. Don't stick your head in the sand because the market's down, and don't just kick rocks. There's opportunities to go after as well. So I might have got off on a tangent there a little bit, but I think the lesson here is this. I can do better understanding more what you're going through and communicate better with my clients and with my audience. Don't just assume that they feel the way you feel because you're confident and you did such a great job of explaining how they're invested, 7 months ago, that when they're being told by everybody else around them that the sky's falling, that they're just going to completely ignore it and be totally comfortable. That's not happening. That's on me. And I'm going to do better. But you as the investor also need to learn the lesson of what your perspective is on how you're invested, what your financial plan is really built for. If it's built for the long term and you believe in the things that you're doing and that you're holding, then short-term volatility around you should not affect that. Not much. If you're uncomfortable, it's because you don't have confidence in what you're doing. And then you need to come back to the table and either get that confidence back by a clear explanation of how you're invested and why, or if that can't be communicated, that can't be articulated, maybe you don't have something to have confidence in and you need to look elsewhere and try to find it. Where can I get something built out that gives me confidence so that when the news is flashing red, I'm going to my tea time, I'm comfortable. I'm gardening in the back. I don't care about it. There's someone else worried about it. And if things get bad enough that I need to make a decision, it's going to be brought to my attention. It's going to be laid out. Here are the decisions to be made, and I'm going to make an educated decision. Until that happens, I feel comfortable that everything is on track. Oh, by the way, I'm just going to zoom out for a second here. Just talking about the perspective. Look at my computer. 1 day gain. It's 11 o'clock on Monday, it's 11 o'clock on Monday the 17th. Right now, market is up just shy of 1%. If I go out to 5 day, we're up 0.75%. If I go out to 1 month, we're down 8%. Down 8% in the last 1 month. This is where the fear comes in. Holy shit. I got 8%, just tack a couple months on that, and I'm down 50%, a couple more, and I'm out of money. I get it. That's extrapolation. That's not how the stock market works. Zoom out. 6 months, pretty much even, about 0.2% to the good. Call it break even across 6 months. So you get paid nothing for your last 6 months, essentially. Year to date, down 4%. Not great. 1 year, last 12 months, the market is up 9.71% as of me recording this right this second. 9.75%. Okay. And I'm talking about long term, 5 years, 10 years more. Okay. But just even the last year, if you're uncomfortable right now, think about what you've gained in the last 12 months. Almost 10%. So if it goes up to 14 and down to 10, you say I lost 4, I say you gained 10. We need to do better finding a view on that in the middle. 5 years, 145%. Last 5 years, up 145% net of recent volatility. So that's perspective. Stay invested. Know what you're invested in and have confidence in it. Build a plan that lasts. Go enjoy your life. Talk to you later.